What's up everyone, it's Cody. In this video, I will share with you step by step on how to sell put options like Warren Buffett. This has been my secret passive income source that generates consistently thousands of dollars per month. I'll walk you through my most recent trade that have helped me generate an annualized return of 123%. Warren Buffett known for being one of the most successful value investors. What most people don't know is that Warren Buffett has also been selling put options to generate an income of $2.4 billion in 2018 and $968 million in 2019. If you feel like your stocks always go against you right after you bought them, or if you want to make money whether your stock goes up, down, or sideways, this video is for you. This type of video takes me a lot of time to make. I want to make sure that you can also join my journey of reaching financial freedom sooner. Smash the like button and subscribe to my channel now to get your ticket to financial freedom. I'll break down this video into 4 parts to make sure it's easy to follow. Part 1. Laying the groundwork. I'll touch upon how to increase rate of return and lower your risk. Part 2. The Lingos, where I will introduce to you some basic terminology. Part 3. Walking you through my most recent trade that generated a 123% annualized return. Part 4. How to make money by selling put option. This is the part where I summarize my thought process before I sell any put option. Let's get right into my part 1, laying the groundwork. You must first understand the importance of your percentage rate of return. This is like the speed limit to your destination. If you're driving to a destination and it is 100 kilometers away and you drive at 100 kilometers per hour, you will reach your destination twice as fast as driving at 50 kilometers per hour. It's the same with investing. If you earn 10% per year, you will reach your destination much faster than if you're only earning 5%. If you can get your portfolio to grow faster, you will see how your dividend income also grow more quickly. Once your dividend income equals the amount of you need to live on, you will never have to work for money again. The long-term return on stock is around 10%. Any investment that can make more than 10% is respectable and will shorten your journey to financial freedom. Bonds, GICs, bank deposit might be good for a short-term horizon, but not great for growing your wealth quickly. What about buying stocks that pay dividends? Dividend payments are much more reliable than stock price. They also let you sleep better if you focus on cash coming into you rather than the stock price fluctuation.
But Cody, you just told me that at the beginning of the video to stop buying stocks.
Yes, I did, and it's still true. The put option selling strategy I'm about to introduce is more likely to generate a better return. The worst thing that can happen to you is that you will get paid to own the stocks you want to own anyways at a cheaper price. Write this down. You will get paid to own the stocks you want to own anyways at a cheaper price. Can you just look at the rate of return and not worry about the risk? The answer is of course not. Last year, people won more than $1 billion playing poker, and the casino made $27 billion just by being around those people. Now, imagine this strategy will allow you to become a casino. You can open up virtual broker tables for speculators. All you have to do is deal the cards and collect the fee for every round of the game. This way, you might not take home millions of dollars, but you will earn steady income just like a casino. To make it even better, being a casino puts the odds in your favor, as long as there are speculators to deal cards to. The selling put strategy is usually deemed to be risky, but if you combine it with buying quality, recession-proof stocks with a history of dividend increase, this strategy increases the return and lower the risk compared to buying stocks outright. It might contradict ideas you already have about investing. It goes against the standard dogma, but the standard dogma has people retiring in their 60s. Don't forget to look at this strategy from a different perspective, in the lens of the casino owner. Now that I lay out the groundwork, let's get into part 2, the Lingos. First thing you should learn is how to smash the like button before selling a put option. Selling options for income is easier than you might think. It's one of the few strategies where you can be wrong about the direction of the market and still win. Warren Buffett, one of the most successful investors, actually used this time-tested strategy to generate income. While this strategy is easy to understand and execute, you should spend some time learning the basics before you execute your first option trade. Let's look at what an option is. If you're new to option trading, trust me, learn the fundamentals. Just think of the word option in our everyday life. An option is a choice. It works similarly when you're talking about investments. When you're investing, an option gives you the opportunity to buy or sell a stock at a certain price on or before a specific day. There are 2 types of options: call options, put options. If you buy a call option, you're expecting that the underlying stock is going to increase in price. If you buy a put option, you're expecting that the underlying stock is going to decrease in price. You do not buy options with this strategy. You're going to be selling put options. In this case, you will make money whether the stocks increase, stay put, or decrease in price. Strike price. The strike price is the predetermined price that you can buy or sell the underlying stocks for. Expiration day. Option contracts don't last forever. You need to exercise your option before or on this day. Or you can let it expire when you're selling options and just keep the premium. Here comes the juicy part, the premium, aka time value. When you buy an option, you're buying the time value for the stock price to move in your favor. The price you pay for that option is called a premium. Each option contract consists of 100 shares of the underlying stock. Now, if you're selling a put option, then you're on the other side of the table. You're selling time value to speculators, and you will receive the premium as income. Remember, selling put option allows you to be the casino now. You're just stealing cards and collecting the fees as income. Are you still with me? I know this might sound confusing at first. Even though this video is explained in plain English, you might need to go through the video a couple times to fully understand. Don't get discouraged. The information I share is a lot easier than high school subjects and is more valuable as well. My hope is that this video will allow you to live a more comfortable life and have more time to smash the like button and support my channel. Now let me walk you through my most recent trade that generated a 123% annualized return. I'll first analyze the chart and share why I made this trade. Then I'll walk you through exactly how I profit even when the stock price went against me. Kroger is the United States' largest supermarket by revenue in 2019, and the dividend's growth rate has been growing at 13.4% per year. I've been waiting for the stock to pull back to add on more position. I'm not going into details about Kroger's, but you can learn the detailed analysis about this company in this video. And this is exactly what happened on June 12th. Kroger pulled back below their 50-day and 200-day moving average. As I discussed in the technical analysis video, 50-day and 200-day moving average can act as major support level. And I know that a good stock like Kroger is very likely to bounce back up from this support level. So I decided to sell some puts right below the stock price $32.35. I sold 2 put contracts on June 12th. The quantity is showing -2 instead of +2 because I sold the puts instead of buying the puts. KR is the Kroger's ticker and the strike price is at $31.50, expiring June 19, 2020. The P behind the strike price stands for put contract. If it's a call, it will be a C. I got paid $212 as premiums. This is the fee casino collects from the speculators. Remember what I said earlier about if you feel like your stocks always go against you right after you bought them? It happened to me as well. The stock price kept dropping from June 12 to June 15. The stock price recovered back above 200-day moving average before it plummeted down to below $31 on June 18. The stock price of these 2 puts was at $31.50, and the stock price was then sitting below my strike price. You might be thinking,
Uh-oh, Cody messed up. Let's see what he's going to do.
Since I'm selling put options, I'm selling the value to the speculators on the other side and receiving the premium as income. Each day that passes, while the stock price is above the strike price, there's less and less probability that I need to buy the 200 shares of the underlying stock. The time value would decay. As the time value decays every day, I can buy back my contract at a cheaper premium to close the position. A good example would be, imagine you are an insurance company. You provide a 7-day travel insurance plan for $212. Your customer never make the claim during the first 6 days. On the last day, you offer your customer $60 to cancel their travel insurance, and they say yes because they don't think they need it anymore. And this is exactly what I did to close my 2 put options. Right after the market opened on June 19, the stock price recovered to $31.66, which is above my strike price of $31.50. I took the chance to buy back these puts for $60. By closing the position, I realized a $149 as a profit. Because I might need to buy 200 shares of KR at $31.50, I set aside $6,300 to make $149. This is roughly 2.36% return and is annualized to a return of 123%. And you just witnessed how I make money even when the stock went against me. Selling put allow you to win whether the market moves up, down, or sideways. If you trade option using this strategy, you can be less risky than trading stocks. The worst thing that can happen is that I will get paid to own the stocks I want to own anyways at a cheaper price. According to the Chicago Board of Option Exchange, selling options is one of the few strategies that outperforms the buy and hold strategy over time. If you want to learn more about the selling put option strategy, join my private Facebook group to view my past trading position and bounce ideas with like-minded investors. Click the link in the description. Part 4. How to make money by selling put option. Here is my thought process before selling a put. Number 1. Find good quality dividend growth stocks that I want to own for the long term. Number 2. I will decide on the strike price that I will be comfortable buying these stocks for. Based on technical analysis, I will find a major support for those stocks. I don't need to know where the stock is going, but instead I'm trying to predict where the stock price will not be at by the expiration date. Number 3. I will check the volatility index, VIX. VIX measures the level of fear or stress in the market. When the fear is high in the market, I will get paid more premium as the insurance seller. Imagine if you are selling umbrellas, where your customer pay more for your umbrella on the sunny days or rainy days. I will give you 3 seconds to think. 3, 2, 1. Yes. You will get paid more on rainy days because of the fear and stress that the rain is causing your customer. The average VIX price for the past 10 years is around 16 to 20. So when the VIX is lower than 16, I will sell less puts and keeps cash on the sideline. I'll wait until the fear in the market built up again before selling more puts. Number 4. Capital requirements. This is by far the most important point. Before you sell one put, make sure you have enough money to buy 100 shares of the stock, or else you are using margins. This means that you are actually borrowing money from your broker. Do not use any margin, especially when you're starting out with this strategy. Using margin is a double-edged sword. You can make more money, however, when you lose, you can wipe out all your gains and even more. And you will wonder why you put in so much work to earn these income and you give them up so easily. I'll dedicate a video to margin usage in the future. For now, stick to the rules. Don't use any margin. Thanks to all my passive income source, if I really want to, I can retire today at the age of 29. The more important question is, why am I able to retire so young while most people work into their 60s? How can you also achieve early financial freedom? I thought about this question and came up with the reason. The reason is because of financial literacy. I can choose to retire early because I have the financial literacy. Most people spend years acquiring the skills they need to excel in their career, and this is a good thing. However, spending just a little more effort learning how to manage your money better will shorten your journey to financial freedom. Good job on staying until this part of the video. You all are my true supporters. You all deserve to smash the like button for yourself. If you enjoyed this video, support me by destroying the like button if you haven't done so already. Subscribe and click the notification bell and change it to all. Thanks for watching and see you in a couple days.